Gold just crossed $5,000 an ounce. It's up over $2,000 in 12 months. Central banks are hoarding it. Ray Dalio says put 15% of your portfolio in it. And Bank of America just put a $6,000 target on it. While everything else crashes, gold keeps printing new highs. Here's why. Three forces are converging at the same time, and all of them are bullish for gold. First, war. The US and Israel launched strikes on Iran. Iran's supreme leader was killed. The Strait of Hormuz is under threat. Oil is surging. When geopolitical risk spikes, capital runs to the one asset that has worked as a safe haven for 5,000 years. That asset is gold. Second, central banks. Global central banks have been buying gold at record levels since 2022. China, India, Turkey, Poland, they're all diversifying away from the dollar. The reason is simple. After the US froze Russian reserves, every country on Earth realized their dollar holdings could be weaponized. Gold can't be frozen. Gold can't be sanctioned. Gold has no counterparty risk. Third, debt and inflation. US national debt is spiraling. Inflation is running hotter than expected. January PPI came in above forecasts. The Fed is stuck between rate cuts that risk reigniting inflation and holding rates that risk a recession. Gold thrives in exactly this kind of uncertainty. Gold hit $5,408 on March 2nd. It swung between $4,500 and $5,400 throughout March as the Iran situation escalates and de-escalates. For perspective, gold was around $3,000 a year ago. That's an 80% move in 12 months. The last time gold moved this fast was during the 2008 financial crisis. Bank of America expects gold to reach $6,000 within 12 months. UBS says 20% more upside from current levels. Ray Dalio, the man who runs the world's largest hedge fund, is publicly telling investors to hold 10 to 15% of their portfolio in gold. He calls it the safest diversifier available. Now the other side. Gold doesn't pay dividends. It doesn't generate earnings. Over the very long term, 1971 to today, stocks returned 10.7% annually versus gold's 7.9%. In a strong economy, gold underperforms equities significantly. If the Iran situation de-escalates quickly and the Fed manages a soft landing, the fear premium in gold unwinds. The price could correct 20 to 30%, just like it did after the Russia-Ukraine spike in 2022 peaked and reversed. And at $5,000 an ounce, the entry point feels stretched. Buying at all-time highs requires conviction that the macro environment stays ugly. If it doesn't, you're holding an expensive rock. So what's the chaos capital take? Gold is not a trade. Gold is insurance. You don't buy it to get rich. You buy it so the rest of your portfolio doesn't make you poor when the world breaks. And right now, the world is breaking. War in the Middle East, oil above 90, inflation re-accelerating, debt exploding, trust in fiat currencies eroding globally. Every one of those conditions is structurally bullish for gold. Dalio recommends 10 to 15%. That's a reasonable allocation. Physical gold, GLD for ETF exposure, or gold miners like GDX if you want leverage on the price. Don't chase the highs. Dollar cost average in. And understand what gold is. It's not a growth asset. It's the asset that holds value when growth assets don't. Stocks can crash. Bonds can default. Currencies can devalue. Gold has survived every financial crisis in human history. That's not a pitch. That's a 5,000-year track record. The capital markets are chaos. Embrace it, and I'll see you in the next video.